Well, I think the first thing to say is the financial crisis was a really big and very painful lesson for all of us. I think it's not just the money that had to be put in, taxpayers' money to the banks, but also the crisis and the recession that followed, on average, probably meant that everyone in the UK was about £20,000 worse off than they would have been. So it's really important that we've learned the lessons and the system is safer. I do think it's safer, I think it's simpler, and I think it's stronger than it was before the crisis. And I think there are three reasons for that. The reforms we've put in have tried to do a number of things. First, we've stopped banks taking some of the risky activities they were taking, and equally important, made sure that they're measuring properly, they're scoring properly the real risks they're taking and managing that. We do that through the rules, but also through much more intrusive supervision of the banks and their operations. And next, I think, banks have to take risks. And those risks will sometimes go wrong. Banks will make losses. But you have to make sure that when they take those losses, they can absorb them without just falling over. And that's where bank capital is important. The bank capital in the system now is about 10 times as much as it was before the crisis. And it's not just the quantity of capital, it's the quality. It has to be real money, basically shareholders' funds that can absorb losses when loans and other things go wrong, and ensure the bank can keep operating and can keep providing the sorts of services, lending, transactional accounts that we all depend on. And finally, it's not just capital, it's also liquidity, because sometimes the market dries up, banks can no longer borrow in the market, and they have to be able to withstand those periods of market stress and carry on providing services. And banks in the UK are now having about 4 times as much liquidity, about £600 billion, compared to what they had before the crisis. And the last thing I'd say is banks will, a bank may well fail, and then you have to ensure that if a bank fails, it can do so safely without just cutting off the services it provides the economy. And it was because banks couldn't fail safely without cutting off those services that the taxpayer had to step in during the crisis to save the economy from the banks. And we're putting in place a regime that can ensure that if a bank fails, it can be wound down safely and the losses can be borne by the people who profit from the bank in good times and not by the taxpayer. So for those reasons, I think the banking system is safer and stronger than it was.
You've mentioned that banks aren't engaging in bad practices anymore, but yet we are seeing, for example, an increase in things like interest-free credit periods being offered by credit card lenders. I mean, do you worry that stresses are building up again in the system?
It's one of the key reforms that we made after the system was to give the Bank of England the responsibility for the stability of the financial system as a whole. It's my direct responsibility as Deputy Governor for financial stability to ensure that we can scan and monitor problems, risks that might be building up in the system, exactly the sort of thing that you mentioned. And the Financial Policy Committee of the Bank of England does that. It does that 4 times a year. We publish our reports on risk twice a year. We've taken action, for example, on mortgages, on bank capital, before those risks build up too greatly. And at the moment, we're looking very closely at this question of consumer lending, lending to consumers, some of the credit card practices we've seen, to see whether they are a risk to the financial system and whether action needs to be taken. And we'll be reporting on that at our next meeting.
You're an old Brussels hand. How much of a challenge is Brexit going to pose to the resilience of the banking system?
Well, our job is to make sure that the resilience of the British banking system is maintained regardless of developments that happen, including the outcome of the Brexit negotiations and the Brexit process. And we're focused very, very closely on this. We're monitoring the plans of the financial institutions in the UK, their plans for how they're going to deal with Brexit. And we're also monitoring the plans of all of the European Union firms that operate in the UK and in the City of London to look at their plans for how they are going to manage Brexit. And if we start to see financial stability risks coming out of those plans the way they think Brexit will affect them, then we'll take action to monitor that. And the other point, which comes back to something you mentioned, stress testing. The purpose of our annual stress test is to subject the banking system to a very, very severe economic shock, the sort of thing that is not likely to happen, but could happen, and to see that it's got the capital and the ability, the resilience to withstand that shock, keep lending to the real economy, keep providing services. And we've tested the system against a number of scenarios. We'll continue to do that, and that's one way we'll be able to maintain resilience regardless of outcomes.